Hello everyone and welcome to this first session. Today we have the chairman, Jonathan Price, and the CEO of Yanda, Mario Stumpo. How are you guys today?
Fine.
Yeah, I'm great. Thank you, Ilaria.
I'm fine. What about you?
I'm good, thank you. Very good. So guys, today our experts in finance, Jonathan and Mario, will answer some very interesting questions. The first question is actually for you, Jonathan. Are you ready?
Yes, fire away.
So hedge funds have been in the news recently as a result of the strange going on at Gamestops in New York. What do you think about that?
Yeah, it's been really exciting, hasn't it? So just in case anybody's not really aware, there's this small video game company quoted in America called Gamestop, which was in a really poor condition because it operates physical brick and mortar stores. And of course, most of them being closed because of COVID. So the company position was really very weak. And lots of the institutions, particularly hedge funds, were betting that this company would go bankrupt. So they had sold the shares short. However, individual shareholders started to talk about this company on Reddit, on a particular bulletin board dedicated to smaller cap shares, and they decided that these shares were undervalued and that there was potential to make some money. So they started buying, and this the messages, the discussions went viral around this Reddit group. And gradually, more and more of the retail investors using their free trading accounts like Robinhood started to buy these shares, and the price started to go up. After a little while, the hedge funds got really afraid because they were expecting the share price to go down, but instead it was going up. So they started to incur losses. So after a while, some of them began to lose their nerve and started to close their short positions by buying some of the shares. Of course, that made the price go up even further. And eventually, this thing got all sorts of momentum, and the price shot up to a high of over $300 a share from around about $5 where it had been when this all started. And the losses that some of the hedge funds incurred were so great that two of them effectively became insolvent, had liquidity problems, and had to be bailed out. One called Melvin Capital, another called Citron Research. So this was absolutely crazy. Nobody had ever seen anything like this before. And the reason, what enabled it, the small investors to have this effect was that the short sellers had sold short too many shares. At the peak of the short position, the short sellers between them had sold 140% of the total free float share capital of the company. So that was just setting it up perfectly for a short squeeze, which is effectively what the retail investors did to them. So it was great fun, but it caused all sorts of market disruption. And in the end, Robinhood had to put a stop to anybody else buying the shares because they were themselves getting into problems with lack of collateral. But it was very exciting when it went on, and caused a lot of comment on in the financial news.
I liked it myself because I was a keen customer of GameStop since I bought a couple of PlayStations during my youthness. So what I would say is that this is really the show up of a generations, the one of the millennials, that's been able to do something really, really dramatical, which was beating on their games the boomers. I'm sorry, Prof. I know you're a boomer yourself, but you're not actually acting as one. But the main thing is that there is a generation right now which is upset with the old way that finance moves the money and moves the values. And that wasn't really, I think, a valuation from a high valuation from the guys of Reddit of the shares of GameStop. Was more a point So they stated the point, and the point was, you're not going to play anymore with our markets. And this is crazy, because when I was studying economics, the Adam Smith theory on the visible hand, it was something like crazy, because you have, while you grow up, after 28, especially 2008, you grow up with the expectation that the market is actually manipulated heavily. And so seeing the boomers being distracted at their own game, it's been fantastic. And it also had some reflection, well, big reflection on the crypto world, because then we had Elon Musk tweeting about the Dogecoin and pushing people in the Bitcoin adoption, especially with the meme coin, which is the Doge. And so we had the same reflection on the Dogecoin that pumped up to 497% in a couple of hours during the GameStop shares were rising. Yeah, it was a crazy moment. But Jonathan, you had great insight about that. And the short squeeze is a practice that actually I don't like. I would like to see a finance where companies should fail fairly, and not because some hedge funds heavily bets against them.
Yeah, I mean, this is a really interesting question, because it is true, as you were saying, that there was a sort of spirit of populism between all of these younger investors on Reddit and the other bulletin boards, and they were definitely, they had in their mind that the hedge funds were the enemy, and that they, you know, it was the haves versus the have-nots. You know, it's a bit like Les Miserables, if you've ever seen that. It was that kind of feeling. So they got really excited. Yeah. So, yeah. Well, hedge funds. You know, I agree. Shorting. The practice of shorting stocks has its supporters and its detractors as well. I mean, it's a bit of a controversial subject.
Thank you, guys. That was actually such an interesting topic, because last week all the internet was just talking about that. It's crazy, just completely went crazy. Now, Jonathan, I got another question for you, if you don't mind. This is about hedge funds, actually.
Yeah.
Do you think that hedge funds have been a good influence or a bad influence on the market over the past 30 years?
Well, yeah, that is a really key question. I mean, hedge funds have been around for a really long time. The first recognizable hedge fund was way back in 1949, even before I was born. And that was a leveraged long-short fund. And that's it's worth explaining, because this contains the essence of a hedge fund idea. This was a fund manager, Alfred Jones was his name, and he wanted to go short of particular funds, but he didn't want to run the risk of the whole market moving against him. So he developed this technique of being simultaneously long and short in companies in the same sector, but different companies. So if he thought one company was overvalued in the sector, he'd go short of that company, but he'd buy shares of other companies in the same sector, so that if the market did go up as a whole, if the whole market went up, he would be hedged, because the value of his long positions would increase even at the same time that his short position was going into loss, and vice versa. So this was the idea of the hedge fund in the first place. And these hedge funds got really, really popular. And the idea that you could create some kind of value by clever analysis of the markets got really popular in the late 80s and 1990s. And people took this same idea and applied it to other areas, and they built models to try and choose the right combinations of securities. But the whole idea was, in a sense, you invest in securities that move in different ways, which protect you against general market movements, but allow you to exploit clever analysis. And so this was, as I say, got really popular and applied to all sorts of different types of instruments. And by the end of the 1990s, one of the most famous firms involved in this type of analytical investment was a firm called Long-Term Capital Management. And they had some super clever people working for them. They even had a Nobel Prize winner amongst their directors. And they had developed a system for, again, investing in pairs of securities. And they were betting that the relationship between the values of these pair of securities would stay consistent, because historically there had been. Unfortunately, some of the securities that they were investing in were Russian securities. And in 1998, Russia got into a lot of trouble, and the markets as a whole became disturbed by this prospect of a Russian default on its debt. And so the historical relationships between the pairs of securities didn't work anymore. And there was a huge divergence of values, which wasn't anticipated by the model. And long-term capital management, which had used extremely high leverage to maximize the returns from small differences in price, became illiquid and essentially went bust. So it just shows that you can employ the cleverest people in the world, Nobel Prize winners, and still get it wrong and still go bust. So after the long-term capital management failure, the idea of a hedge fund was tarnished a little bit, and the whole market took a while to recover from that. But subsequently, the concept came back into popularity again, particularly in the world of stocks, of shares rather than bonds, and driven partly by the enthusiasm from a couple of academic institutions that had endowment funds they wanted to invest. And the most famous institution for pioneering hedge fund investment was Yale University. They put quite a large percentage of their endowment funds in either hedge funds or private equity funds. And they ended up these days being a pioneer, really. And it's not unusual now for a major college or university in the US to have 20 to 30% of its endowment funds in hedge funds. And these are very big sums of money we're talking about, because they're very well endowed, these American universities. And other institutions looked at the success of Yale and others, seeing the profits they were making, decided to copy them. And one of the most notable ones was the California Public Employees Retirement System. So the pension fund for public sector workers in California. It's one of the world's largest. They started to put huge amounts of money into hedge funds. They started off with $1 billion, and now it's multiple billions of dollars. So these guys have got tons and tons of money. Now, it always happens that when lots of pots of money get together, the people managing that money make sure that they get rich. So the hedge fund managers are well known in the financial world as being extremely well-paid people. And of course, this generates part of this inequality between the salaries and the bonuses of these high-powered fund managers, and the difference between their salaries and those of the ordinary man in the street is exactly the sort of thing which generates the kind of resentment which, as Mario was explaining, was shown in the GameStop story. So you see, these conditions tend to work towards revolution. Now, I haven't really answered your question properly yet, which is, are these a good influence or a bad influence? Well, there are various ways you can look at this. They do definitely do some things which are good. So, for example, hedge funds do help the market, the trading market, to have a certain depth. By that I mean the ability to execute large transactions. So because they trade in big sizes, they can provide liquidity in terms of the size of transactions people are able to do. They also, because they often focus on small gaps between different securities, they help to keep the spread between bid and offer prices narrow, which benefits everybody. I mean, nobody likes to have a wide spread between the buy price and the sell price. They also help with the speed at which transactions can be executed, because they are very, very closely connected to the market. They watch the market very closely, and so they tend to be there quite quickly. So all of these things benefit the market, because generally speaking, the more liquidity a market has, the better. But there is a negative side as well, because as Mario commented correctly, sometimes they can force the share price of a share down simply because a group of them think that the price is overvalued. And if they get their bets wrong and the market wrong, we can see what happened with long-term capital management. There's a systemic risk involved. So if one of these big hedge funds becomes illiquid, then that can damage the whole market. So it's a sort of mixed bag. Some good things, some not so good.
Well, I
That's
assume
good.
that, yeah, just to comment on something, I'm curious about the fund of the 1949 and how they were managing to retrieve information at that time from the companies. There's a lot of inside work to do.
Yeah, so there was. Well, back in those days, and even as as late as the 1980s, there weren't any computer resources, so it was legwork. You had to go and do it, field work. You had to go and visit the companies, ask questions, write things down, pen and paper, and then do calculations with slide rules. So it was very laborious. Everything happened more slowly in those days.
Yeah, it's really fascinating to recall that. But
Yeah, thank you so much, actually, Jonathan, for sharing your knowledge and your point of view with us. That's very, very appreciated. I got
Well, you're
one
welcome.
last question for you, if you don't mind. Quick one.
Yep.
So now, what do you think will happen to GameStop?
I think now the fun is over. The price of GameStop shares has fallen back from the peak down to, I don't know what it is today, but $80 or $90, something like that, which is still probably more than the company is worth, but less than the strange peak it got to. I think the most likely scenario is that when the fun has all died down and everybody's forgotten about GameStop, the company will probably still go bust. Unless somebody decides to buy it. It's a famous company now. The other possibility is, of course, that the management somehow take advantage of the share price to raise some new money and use that to reinvigorate the business. So I suppose if they were able to do that quickly enough, they might use it as an opportunity to save the business. But frankly, probably that's unlikely. So I think after this period of amusement, GameStop is going to end as many bricks and mortar companies, retail companies, are ending at the moment, which is in a sad but slow decay into oblivion. But I could be wrong. I mean, I'm by nature an optimist, so it'd be good if GameStop did find a way of surviving. But personally, I'm not betting on it myself.
I guess we just have to wait and see. Mario, would you like to add something to the call?
yeah, well, GameStop wasn't the only one actually that suffered or benefited from the run. Also, some of the companies like BlackBerry and Nokia were involved in the pump scheme from Reddit, if we may. So, yeah, I totally agree with the point of view of Jonathan. I think that if the management was able to monetize and capitalize on the pump of the shares, then GameStop will have a future. Well, Netflix was a complete different company because before they went digital, so they were a small competitor of Blockbuster at the time. So also GameStop can have a future. The problem is that when you have a huge amount of physical stock in your warehouse, which is getting old on a daily basis, such as video games and consoles and things of this kind, with new fast-growing digital era, is very difficult to catch up. We have products from Google like Stadia, which introduced a cloud console, so you don't need to have a PlayStation or Xbox anymore. You can just run it onto your browser onto Chrome. And there are also other tools like the VR machines that are disrupting the market right now. So GameStop actually failed to catch up with the market during the last few years, if not during the last decade as a whole. And yeah, well, I can't blame the hedge funds really trying to short against it, but this is not the point. The point was that the whole generation of the millennials involved with the Reddit group wanted to make a point, and the point is that shorting is not so nice as a practice because it can determine the future or the life or death of a company without giving it the time to fail naturally. And that was the point that they wanted to make, together with the point of declaring that the old finance infrastructure is flaky and can be tampered by just a bunch of people onto Reddit. So there's a lot to think about, my point of view.
Yeah, it is the power of communication. It's interesting to see that the next target that they've been looking at on these bulletin boards, on Reddit and the others, is the silver market, which brought back memories for old people like me, because people have tried to manipulate the silver market in the past. The most famous example was back in the 1970s. Two brothers, William Hunt and Lamar Hunt, started accumulating huge quantities of silver. And by the end of the 1970s, they had nearly cornered the global market in silver, which is a big thing to do because it's a major commodity. And they were trying to corner the market deliberately. And they just failed to achieve what they wanted to. Ultimately, the market was too big and the prices collapsed. And the largest single day drop in the price of silver occurred on one day in 1985. And as a result of that collapse, the authorities decided they had to take action, and they charged the two brothers with market manipulation. And they, in the end, they settled with the commodity futures, the CFTC in America. And Nelson Hunt was fined $10 million and banned from trading. And his brother made a similar settlement of slightly less because he was slightly less involved. But interesting to see what will happen now, because manipulating a market in a relatively small company is one thing, but manipulating a market for a major commodity like silver is quite another. So it'd be interesting maybe to review in a week or two's time what has happened to the silver market. We could put that down as a future subject for discussion.
Yeah,
absolutely. That's such an interesting topic.
All right. I think that we exhausted the time already. So it's time to say thank you to Jonathan. I think we'll see him soon on another Yanda video, right, Prof?
Absolutely. Yeah, I'm looking forward to it.
Thank you very much for joining us today.
Thank you, Ilaria. Bye now.
All right, guys, thank you so much for your participation.
Good.
Ilaria,
Yeah.
thank you so much.